and thank you for joining us on Max Healthcare's Q3 and 9M FY24 earnings conference call. We have with us Mr. Abhay Soi, Chairman and Managing Director, Mr. Yogesh Sareen, Senior Director and Chief Financial Officer, and Mr. Keshav Gupta, Senior Director, Growth, M&A and Business Planning. We will begin the call with opening remarks from the management, following which we will have the forum open for an interactive Q&A session. Before we start, I would like to point out that some statement made in today's call may be forward-looking in nature, and a disclaimer to this effect has been included in the earnings presentation shared with you earlier. I would now like to invite Abhay to make his opening remarks.
A very good morning to everyone and a warm welcome to Max Healthcare's earnings call for the third quarter. This quarter has been exceptional for us, primarily for two reasons. First, it represents our 13th consecutive quarter of year-on-year growth. We recorded a healthy increase in network revenue and EBITDA by 14% and 12% respectively. And more importantly, we managed to grow ARPOB and EBITDA per bed sequentially despite Q3 being a seasonally lean quarter. Second, this quarter marks our foray into central UP, which is one of the most populous and fast-growing states in the country, through the acquisition of 550-bed Sahara Hospital in Lucknow. This acquisition will fortify our presence in northern India and is in line with the articulated strategy of entering new markets where peers have demonstrated success. We expect to consummate the transaction in Q4 and are ready with a plan of action to improve the infrastructure, augment the operational bed capacity, add to the existing medical talent, as well as integrate the hospital with the IT systems. On the clinical front, we have launched the CAR T-cell therapy at Max Vaishali in collaboration with ImmunoAct. Also known as a living drug, this groundbreaking therapy is expected to enhance the quality of life for many patients and reflects our continuous endeavor to provide our patients with the latest therapeutic options for cancer treatment. Now coming to the highlights of Q3 performance. Occupied bed days dipped marginally by around 1% year-on-year due to lower prevalence and spillover of vector-borne diseases in this quarter compared to last year. Average occupancy for the network was 73%. Institutional bed share at 29.5% compared to 29.4% last year and 27.3% in Q2 this year. However, after excluding Max Shalimar Bagh, the overall institutional bed share stood at 27.4% during Q3, and occupied bed days were down by 8% for this segment. Sequential increase in institutional bed share was a conscious call taken owing to Q3 being a seasonally weak quarter on occupancy. Average revenue per occupied bed for the quarter improved to rupees 76,800, growing by 15% year-on-year and 3% quarter-on-quarter. Year-on-year improvement was witnessed across all specialties, with oncology, neurology, and renal sciences being the key drivers. Network gross revenue was around 1,779 crores compared to 1,559 crores in Q3 last year and rupees 1,827 crores in the previous quarter. This reflects an increase of 14% year-on-year, driven mainly by growth in ARPOB. Revenues declined by 3% quarter-on-quarter due to festive season in Q3 and vector-borne diseases led jump in admissions during Q2. Revenue from international business grew significantly by 25% year-on-year. This payer channel now accounts for around 9.4% of the total revenue from our hospitals. Network operating EBITDA stood at 471 crores, reflecting a growth of 12% year-on-year and a decline of 5% quarter-on-quarter. Most importantly, annualized EBITDA per bed rose to a highest ever of rupees 75.6 lakhs, clocking a growth of 13% year-on-year and 1% quarter-on-quarter. Operating EBITDA margin stood at 27.9% for the quarter. Year-on-year growth in EBITDA was impacted due to additional charge of rupees 25 crores driven by movement in provision for doubtful debts, reversal of provision for old phantom stock option plan in Q3 last year after launch of the new ESOP scheme in November 2022, GST impact of variable management fees and one-time litigation cost. Max Shalimar Bagh, where we added 122 beds, recorded year-on-year growth of 36% and 42% in its revenue and EBITDA respectively, with an average occupancy of 74%. Profit after tax was rupees 338 crores versus 269 crores in Q3 last year and at the same level as in the previous quarter. Year-on-year improvement of 26% was primarily attributable to flow-through of improved EBITDA and lower finance costs. Free cash flow from operations generated this quarter amounted to rupees 226 crores after additional outlay of 40 crores for purchase of robotic systems at 4 of our hospitals. Of this, rupees 137 crores was deployed towards the ongoing capacity expansion projects and 97 crores was distributed as dividend. Net cash position improved to rupees 1,295 crores at the end of December 2023 compared to 372 crores same time last year. Continuing our efforts to support the local communities, we treated approximately 36,700 patients in OPD and 1,250 patients in IPD from economically weaker sections of society absolutely and entirely free of charge. Both our strategic business units continue to maintain their growth momentum. Max at Home reported a top line of rupees 44 crores, reflecting a strong growth of 24% year-on-year and 5% quarter-on-quarter. We continue to witness good demand for the SBU services as demonstrated by over 50% repeat transactions by patients in the last 1 year in our home care service alone. Max Lab, the non-captive pathology vertical, now offers its services in 41 cities and has a network of over 1,000 collection centers and active partners. This SBU reported a gross revenue of rupees 34 crores, reflecting a growth of 20% year-on-year. On the status of our expansion projects, Dwarka, for the 300 beds. As informed previously, application for occupancy certificate was submitted in October. Finishing is under progress. In the meanwhile, we already have the unit head and all other key functional heads in place. We have commenced hiring for middle-level staff as well. For the 329 beds at Nanavati, basement and ground-level structures have just been completed, while steel fabrication above ground floor has begun. The project continues to be largely on schedule. For 300 beds at Sector 56 Gurgaon, approval for structural drawing has been received in the first week of Jan and RCC works have already commenced. 190 beds at Mohali, design development is under finalization. In the meanwhile, the base raft concrete activities have started. Both these are largely on schedule. 350 beds at Max Smart at Saket Complex. Tree transplantation work is underway with 159 trees transplanted and balance 316 trees in process for transplantation. As per plan, existing structures have been demolished and shoring work for sewage and water treatment plants is going on. Barring the initial delay of 6-7 months, the project is on schedule now. For 300 beds in Max Vikrant at Saket Complex, the building plans have been resubmitted to the municipal corporation post their initial review, and water and sewage infrastructure, there were some payments to be made that has been paid and that will be connected. Tender documents are underway for floating to contractors. Application for NOC by Forest Department has also been filed. For 250 beds at Patparganj, the Fire Department issued NOC for the building plans and municipal corporation approval is in progress. All projects continue to be largely on schedule despite some disturbances linked to enforcement of GRAP, which is the Graded Response Action Plan in NCR to combat air quality issues. Finally, moving on onto the overview of the company performance for the 9 months ended December 31, 2023. Network gross revenue stood at 5,325 crores, reflecting a growth of 16% year-on-year. Network operating EBITDA grew by 17% year-on-year to rupees 1,404 crores. Increased ARPOB, improved case mix and augmentation of network bed capacity by 146 beds translated into improvement in EBITDA per bed by 15% to rupees 73.8 lakhs per bed. During the 9 months, we generated rupees 924 crores of free cash flow from operations after interest, working capital changes and routine capex, of which rupees 265 crores has been deployed towards ongoing expansion projects and rupees 97 crores was distributed as dividend. With this, we open the floor for question and answers.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask questions may please press star and 1 on their touchtone phone. If you wish to withdraw yourself from the question queue, you may press star and 2. Participants are requested to use only handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Damayanti Kerai from HSBC Securities and Capital Markets. Please go ahead.
Hi, good morning and thank you for the opportunity. My first question is on this institutional tariff revision, which we saw in the month of December. So you mentioned there will be net loss of around 6 crore annually. Is this like ongoing? And just want to understand if this wouldn't have happened, the net gain which you mentioned for third quarter, 14 crore, should we have added this 6 crore back, like 14 plus 6, if the PET prices were not declined?
No, Damayanti, so basically 14 crores is for the quarter, right?
Okay.
So that's the run rate. That run rate also has some impact of this price revision which happened in the month of December, right? So around 1 week impact is already coming there. So 6 crore number is the annualized number, 14 crore number is a quarterly number. So I think now you can do what you want to do.
Okay, and in addition...
Coming to the question, if you didn't have the 6 crore, then you would have added back to this EBITDA. You would have added to this EBITDA. Not for this quarter, for the whole year. 1.5 crore.
1.5, okay. And do you expect any further revision in tariffs for this channel, or do you think now government is broadly done and we might not see any additional revisions?
We are expecting a revision in tariff. Even this PET-CT thing, we think, which has been erroneously done. We've made representations, so we are in talks with them to revise it.
Okay, so further can come, right? And then that should be maybe beneficial to our institutional channel.
Even I expect this, hopefully this PET-CT should get revised because it went the other way. We believe it was an error.
Okay. That 10,000 going to some 11,500 or something, right?
No, so Damayanti, the tariff for the PET-CT had come down by around 50%, right? From 22,500 to 11,000 something. So it was 50% reduction, and that's major impact because oncology happens to be a big share of revenue for us, and so that was a 10 crore impact for the PET-CT. The cardiac had gone up by around 4 crores, so net impact is 6 crores, right? And that's all annualized numbers I'm talking.
Okay, understood. And Abhay, I guess a few quarters back you talked about this Heal in India initiative, which should be giving good boost to your international business. So any update on that front or any discussions ongoing around that initiative, which you could share?
They haven't done a big bang as it was expected. What they've done is, there's a lot of movement in the embassies and so on and so forth. They're fast-tracking medical visas. They've taken off those policies of reporting to police stations. They're they've brought down the price of the medical visas and generally promoting it globally. The government of India is participating in various medical tourism forums and so on. And this is, right now it's leading to a trickle effect. Trickle effect meaning its growth of 25%. Some manner it is not, but given the size of the opportunity, it's not exponential. It's still incremental, right? At a 25% CAGR on this.
Okay. And from Max perspective, right now it's around 9.4% revenue contributed by international patients. How much it can go up in, say, next 3 years, even if we don't hear any big changes by the government and these kind of small or I'll say regular improvements happen?
25% CAGR. It's not this quarter. Last quarter was the same. The previous quarter was the same. I think last 5-6 quarters has been at this. I don't really see it abating. Yeah, so Damayanti, if the overall growth is 14% and this channel is doing 25%, obviously the share should go up, right, going forward.
Yeah, got it. And my last question is, as you mentioned, oncology is a big focus for you, and you have been investing in this segment. So, which are, I'll say, key growth opportunities as per Mac's focus, and then what kind of expectation you have from this segment in terms of addition to your hospital revenues over next few years?
No, so I think, there are within the three streams really of oncology. You've got surgical, you've got medical, you've got radiation. I think there are various sort of innovations happening within the three itself. If you look at surgical purely, more and more robotics, so it's better A-loss, it's better outcomes, and but at the same time the percentage margins are lower, but absolute value to hospitals is more, because in terms of the EBITDA per bed that you're able to derive from that is higher than what you do for a normal oncology surgery, and that number sort of doubled over last year. So I mean, we're seeing major growth in these. Now, similarly, if you look at radiation, okay, from a typical LINAC, you've gone into now various kind of things and so on and so forth. And so on, there have been other kind of innovations within the medical oncology as well. But now you're also looking at immunotherapy. Like we mentioned that we started CAR T cells. So this is another stream altogether. It's a sub-segment of chemo, but nevertheless, and globally, I think, it's a little expensive right now, and we are seeing prices come down, so adaptability of that is going to be a lot more. But that's what the world is moving towards in oncology, right? Is immunotherapy now.
Understood. Thank you for your answers.
Thank you. Thank you. The next question is from the line of Harith Ahmed from Avendus Spark. Please go ahead.
Good morning. Thanks for the opportunity. My first question is on the recently acquired Lucknow hospital. So currently we have around 250 operational beds there, and we've talked about a capacity of 550 beds. So can you share your thought process in terms of taking the operational bed count higher, more towards the capacity bed count?
So what is, one is the amount of area which has already been constructed. It's about close to 1 million square feet. Number of beds operational are 285. So, there's obviously an opportunity. You can ramp up to the 550 as intended originally within this. The facility has been ignored for a while, so I think we are going to be changing the equipment, and we have to sort of redo the infrastructure. When I say redo the infrastructure, it's basically internal renovation which needs to be done. This is a brand new building made by L&T. A fees contractor construction started in, I think, 2010, 2011. So it's not an old structure, but of course you need to kind of renovate it. So I think within a couple of years we should be at that 550 mark, number of bed mark, in perhaps a little before that. You have keep in mind that we are going to be closing the transaction. We're not in the saddle as yet. There are a majority of the CPs as per schedule have been done. The rest are also on schedule, but till the last one is done, that's the time we'll be able to share more details about it.
Okay. And my second question is on the timelines of some of the upcoming hospitals. So apart from Dwarka, you've guided for 3 other hospitals getting commissioned in the next 12 to 15 months. That's Mohali, Nanavati, and Gurgaon. But when I look at the capex, project capex specifically, we are tracking a bit lower versus our guidance of 900 crores for FY24. We are at around 300 crores in 9 months of FY24. So are we still expecting these 3 hospitals other than Dwarka to get commissioned in FY25?
No, absolutely. So Dwarka, which is getting commissioned, do keep in mind it is off our books because this was the asset-light model, right? The developer is investing the money, whereas we are bringing the medical equipment in place. So the entire 300-bed hospital is not, and the hospital is complete in all respects. We are right now in the phase where we are doing the finishes to the hospital, and sort of whatever medical equipment that we brought in, we are implementing it. It's not going to be a major capex for us going forward either. as far as Dwarka is concerned. It was never meant to be because of the asset light. We were essentially paying a lease amount for that, right? A yield of, I think, 7.5% or something like that. And it's a 60-year contract for the land and building, a finished land and building of 300 beds. As far as Nanavati is concerned, we've already built our 3 basements and we've come to ground level. Now, this is where things start speeding up. Do keep in mind the first part of construction is really the superstructure, which doesn't really cost that much money. I mean, if you were to, it typically costs 1,500 to 1,800 rupees a square foot. So if you're building even 1 million square feet, then you would have spent like 120 crores just doing the construction, right? Which is superstructure. Real money is spent at the latter half part of it, when you go into finishing, when you go into interiors and so on and so forth, when you bring into the high side, low side, equipment, lifts and so on and so forth, air conditioning and all of that. So I think everything, as far as the payments is concerned and this thing is concerned, is on schedule. So I would not look at that, as the payments are always lumpy towards the end. So I would not look at that as a surrogate for completion of project, at least at this stage.
Okay, got it. Last one with your permission. A slightly broader question. When I look at the Saket complex, currently, if I understand correctly, we have around 800 beds there. And in the next 3 years, we're looking to add close to 800, 900 beds, and we have plans to add maybe 500, 600 beds beyond FY28. So that's almost 2,000 beds in almost a single location. It's kind of unheard of. So can you share your thought process behind such a large number of beds at a single location? How are we going to differentiate, and how do we plan to, what is the strategy to ensure that there is no overcapacity situation in that location?
So firstly, the Saket complex is pretty much tearing, it's the main flagship, as you're aware, right? I mean, so we are pretty much tearing at the seams as far as Saket is concerned. We've added, in a place like Shalimar Bagh, we added about 40-50% more capacity, which was then what was present there. And, within the first month or so, our capacity occupancy went up by about 80-85%. My belief is that, and we have collectively very strongly believe that if we were, so this 1,000 beds or 800 beds or 900 beds that you're speaking about is not coming all together, as you may appreciate. First, the 300 odd beds come into play. My belief is when you add 40% capacity on top of this, on top of the current sort of capacity of 770, 800 beds that we have, that will be more or less instantly taken up, right? I mean, you're going to have very quick sort of occupancy of the first 300 beds. And very soon, let's say very, very soon thereafter, you're going to be ready for the additional capacity. Like in Shalimar Bagh, we already run out of capacity, right? So even over here, you're going to have the same situation. So you'll require the next 300 beds. And so, what you can't do is start constructing 300 beds then and take another 3 years. You will need that 300 beds once these first 300 beds are occupied. And that really speaks for the first 3. Now then comes the last phase of, let's say, another 300 beds thereafter, right? Now, that only when this 300 beds, the second 300 beds gets occupied, okay, do you look at the last piece?
Okay.
But you will make the superstructure, which I again mentioned. It's not a major cost, okay? This is if things are going as per plan, but you can always stall. You can always, at the last 300 beds, you can always say, look, I'm completing the superstructure and the external of this thing, I'm not fitting it out. If you see any sort of softness of demand, our belief is this is a trajectory that we have over the next 5 to 6 years, you will be able to occupy all of those beds. But it does not mean that after phase 1, if you're not, let's say for some reason, okay, and which is beyond me to be honest, the first 300 beds don't get occupied, you're not going to fit out the next 300 beds. You're not going to build the next 300 beds.
Okay.
And also, this is a base case. Do keep in mind, at various stages, at various phases, the default options. You don't build it's a hospital. We can't have a disruptive process. The infrastructure, the superstructure cost isn't a lot. Again, if you look at 1 million square feet, it's only 120 crores. So 150 crores, 180 crores for that matter. I mean, that's about it, right? It's not more than that.
Also, FY28 onwards is a placeholder, right? That's a potential. We are not investing anything for the FY28 capacity now. We don't even have the approvals from the board to spend on that, right? So that only reflects that we can build those many beds more on those land pieces.
I mean, theoretically, in Lucknow, if you look at it, it's 27 acres of land. You can build another 3,500 beds. I mean, that's the potential. So you'll see a potential post 28 up to infinity. It does not mean we'll be building 3,500 beds now.
Yeah.
Got it. All right. Thanks, Abhay. Thanks for taking my question.
Yeah.
Thank you. The next question is from the line of Neha Manpuria from Bank of America. Please go ahead.
Yeah, thanks for taking my question. Abhay, on the Lucknow acquisition, how should we think about narrowing the operating performance gap that is there between, let's say, what Max is doing now in Lucknow, particularly since we'll continue to ramp up that bed? Is it fair to assume that we need to get to that full 550 to narrow that gap meaningfully, and it would happen over a period of time?
So we are quite confident that, in the next, within a couple of years, we will be able to get all of these beds, in the sort of condition or perhaps better than what we have in any other hospital, and be able to catch up with our peers as well, and our peers over there, both in terms of, on every financial parameter there, if not exceed.
Okay. But this would take a few years in your view?
No, so like I said, it should be done within 2 years.
Got it. And second, just extending the Lucknow question to a more broader strategy. Now that we have this, we'll have 500 beds. I know you said, you have land for adding more capacity, but do you see that as a market where you can have, let's say, multiple facilities, and is that something that you're looking that this could be a third hub outside of, let's say, the current 2 hubs that you have?
No, absolutely. So, I look at Lucknow justifying certainly many more healthcare facilities. UP's population is the size of Europe, and literally it's got 1.5 corporate hospitals over there right now as we speak. Besides, hopefully when we get in, it will become 2.5. But I don't know if you've been there recently, but the level of development, connectivity, the roads, the infrastructure, the kind of focus that the city is getting, I mean, I think it's going to be a metro very soon, and just the scale of the infrastructure, the airport and so on and so forth, and the connectivity with other areas, backward areas and so on, both from from rail, air, road, every which means. On top of that, the government itself has a very, very strong program that the Chief Minister Fund over there actually pays hospital tariffs for patients. So, I mean, you can imagine the entire population where the Chief Minister's Fund is paying hospital tariffs for patients at hospitals. Not the CGHS rates, not some low rates or whatever else. I mean, I think on multiple fronts, it certainly justifies more than one hospital.
And this would be through M&A, do you think, or to just make it happen faster, or would you, choose a more organic approach of expanding into that market?
Unfortunately, I don't think there are too many M&A opportunities or existing hospitals in Lucknow. They are far and few. I mean, if we are able to get lucky again, like we've got in this case, of course, we'd look at an acquisition first because that's a faster in. But if not, then we look at organic growth as well, built out.
Got it. And my second question is on, Dwarka. I think you mentioned that the unit head, key functional heads have already been appointed. Is that cost already sitting in the quarter? Because if I look at our, the fixed cost, that hasn't increased as much in the last 3 quarters. So,
Yes, so that cost is sitting, and also certain doctors have been sort of onboarded, and that cost may also be sitting in this quarter.
Okay. So as we commission this and phase it up, you should start seeing that contribute to EBITDA pretty quickly.
That's right. Because the cost is already incurred. I mean, it's not a the biggest cost is always the non-medical personnel, right? I mean, it's, I always mention that 23% or 24% of the overall revenue. In fact, for a new hospital, it's higher because the revenues are lower. And that is typically brought in large, that's really the significant amount of heads that you have is under that cost, and that comes in closer to the hospital commissioning, which is now. I think, very shortly you should have that hospital up and running.
And for, break even in Dwarka, is, 12 months, 18 months a good time frame to assume?
Well, that's the textbook.
Okay.
We hope to do it faster, but that's textbook.
All right. Thank you so much.
Thank you. A reminder to all the participants that you may please press star and 1 to ask questions. The next question is from the line of Kunal Dhamesha from Macquarie. Please go ahead.
Hi, thank you for the opportunity. So first one on the institutional rates, I think there has been some revision upward, some revision downward. But when we sum it up, let's say for the first 9 months, what could have been the ARPOB impact in that channel? I think for the first half, we had suggested the institutional ARPOB has grown at 28% year on year. If you could provide that number for first 9 months.
I think if my knowledge, anything go by, that it's been up on everything except for one item which went down, which my belief is a mistake, so we made a representation. But what is the impact?
Yes, Kunal, you have the number with you. I think if the price increase is 14 crores per quarter and there's a 6 crore annualized impact of this, so that means the net impact is 50 crore rupees on the institutional business in terms of price. So if you can divide it with the numbers, you will get the increase in the ARPOB, right?
Which will be what percentage-wise?
Which will be 3-4%.
3-4%?
Yeah. Probably more than that.
So overall ARPOB will be less.
Overall ARPOB will be less than 1%.
Less than 1%
in the overall ARPOB.
But last quarter we had said that the institutional ARPOB increased by 28%, which is 18% of the revenue.
Not we're talking about
overall ARPOB impact is less than 1%.
No, but if your institutional revenue is around 18% and that revenue is growing at 30%, then the weighted average impact should be around 5%, right?
No, so I think let's not confuse ourselves. First of all, the total impact is 50 crore rupees, right? As the things stand today, on the overall top line, which is less than 1%, right? Our top line last year was around 6,600. So if we take 50 crores, that will be less than 1%. So that's one on the overall ARPOB.
This is now last year's revenue. This year's revenue was 17%.
Yeah. So let's say now if you talk about the ARPOB of the institution itself, then we do around 1,200 crores of business in a year from institutional, and this is a 50 crore impact on that, right? So it will be 4%, around 3.5-4% type. Yeah. Okay. Is that clear, Kunal?
Yeah, this is clear. But last quarter, then I don't know.
No, the last quarter growth in ARPOB is not only price, right? We never said that it's all because of price.
There's been a growth in institutional ARPOB, but we haven't said it's by price.
It's still the growth, right? Okay. Even in this year, this quarter, if you see, compare, the price impact is only 4% that. The rest is the business mix. Also, you should understand that when the onco goes up, the chemotherapy goes up. When the chemo goes up, the ARPOB improves, right? And a large part...
We've been focusing even with institutional on the higher end specialties. That's the outcome.
Sure. And the 15% ARPOB growth that we have seen, I think first half was also 13-14%. Going into next year, what is is that you kind of would be thinking about in terms of ARPOB growth? Because clearly these numbers are, in my view at least, is above the historical trend line. And we have been doing high-end surgeries, robotic surgeries. Do you think that this can sustain this run rate of ARPOB growth for the next 2 to 3 years?
Well, you're the analyst. You have to tell me. I mean, I keep asking the same question. Is there any one-time price change which has led to this? I mean, in my mind, there are a few factors which have led to higher ARPOBs. One is more higher-end surgeries. Second is international patients. Third is proliferation of insurance, and so on. These are things which are leading to higher ARPOBs, and if any of these is non-secular, then your guess is as good as mine. My belief has been that they seem pretty secular, and that should lead into next year as well. None of this is based on one time.
Yeah, and now it's not only B, right? So you see the competition, I think the ARPOB has improved in all other hospital chains also.
Yeah.
Right.
There is a non-secular trend which has been propelling it, but I'm at a loss of what it could be.
It's one logistic question on the international patient bed share this quarter, if you can share that.
So it will be around 5.8%.
5.8%. Okay. I have more questions. I'll join back.
Thank you.
Thank you. The next question is from the line of Ankit Shah from Canara Robeco AMC. Please go ahead.
Yeah, hi. Thanks for the opportunity. So my question pertains to the Dwarka additions. So you mentioned that some of the costs have started coming, but major portion of non-medical cost will come going forward. So can you give some sense of how much of that non-medical cost would be of the total cost? So and also you had mentioned earlier that total losses initially in this should not exceed 30 to 40 crore. So can you give some sense on how this, would this be completely front-ended or, cost come in a stepwise fashion, so it will be more divided across quarters? So some granularity on that front would help.
No, I think it'll grade down, so it will be in a decreasing fashion. Of course, the first month is more, the second month should be similar, and then it sort of starts petering down till you hit break even. So the textbook, this size of hospital should have, a similar sort of 40-50 crore kind of loss, but we hope to perform better and maybe break even hopefully sooner.
Okay. So most of this losses...
It is hard to project because as and when the doctors come in, those particular programs kick in, right? Certain doctors will be brought in with certain minimum guarantees, and others with certain other minimum guarantees, etc. Because to give you that loss figure and actually what the trajectory of that loss is, I need to figure out what the exact revenue figures are going to be on that particular month.
Right. But so on the hiring front, does the hiring happen in one shot for the entire capacity, or does it happen in stepwise fashion?
No. So we are going to be coming up with 160 beds first, and of which also let's say we want to operate 100 odd beds. Then we in the first go we will be hiring at least 400 odd beds.
Okay. Got it.
Unless, we get enough of those kind of clinical programs to kick in where we start off with 116 directly. So right now we know we're doing this much, but there always, let's say if there are 20 LOIs which we have issued to 20 various doctors, etc. If 12 or 15 of them have joined, another 5 are in the process, is in the works, right? So as and when I have it in hand, I know this guy's coming, I need to sort of get enough nurses and resident doctors for him to support him.
Got it. Yeah, that was my question. Thank you so much.
Thank you. The next question is from the line of Tushar Manudhane from Motilal Oswal Financial Services. Please go ahead.
Yeah, thanks for the opportunity. So this will be international patient.
I'm sorry.
We're not able to hear you.
Yes, sir. We are not able to hear you.
Am I audible now?
Yeah, Tushar.
Okay. So just on the international patient, would like to understand the growth maybe for the quarter and as well as for the 9 months, how if you could break down into volume and maybe the realization growth.
The growth has been 25%, I think both on 9 months as well as quarter. What's been the breakup?
Yeah, so the ARPOB now has grown by 9% in the quarter, but the bed share is 5.8%, and overall it's flat, right? So it's a 158 crores last quarter and 157 crores revenue this quarter.
Sure. So and then this, right? So this 9% increase in realization is to do with case mix, or it's like the similar treatment?
So there's no price element in this. It basically be case mix. Right? We haven't increased the prices. Typically, the prices of international patients are linked to the self-pay patients, and these get revised only in the month of April. Right?
Sorry, sir, I missed.
I said the price increase for international patient is tagged with the price increase in self-pay patients. The self-pay price increase happens in the month of April. So to that extent, there is no price element in this. It is only the mix which is increasing the ARPOB by 9%.
Understood. And secondly, just on the overall operational cost, in terms of, let's say, employee cost and other expenses for FY25 in particular, where considering the different new hospitals coming up, so what kind of cost increase one should, think about?
No, so we can tell you about the cost increase on the existing hospitals, which is typically an increment of around 7%, and then if there are any additional beds getting, created, there will be many required. So typical many would be 6 people to 1 bed, right? So let's say if we add in 100 beds to the operational capacity, you should assume that there will be 600 more people, and to that extent, you can really value that, right? So I can't give you an exact number of the growth, etc., but I'm just giving you mathematics to really get to the number.
Got it. So effectively trying to understand, considering the scope of ARPOB growth as well, but at the same time addition of cost on account of at the existing sites as well as new hospital getting added. So is there a scope for further margin improvement in FY25, or we would be, let's say, having bed-related revenue growth, but margin would be pretty stable? Is that the way to understand, or there is a scope for margin improvement even in FY25?
No, you're mixing two things. One is your current beds, right? Your current capacity, which is about 3,500 odd beds that we have, right? You have cost growth and you have a revenue growth. Okay. Right. Assuming your revenue growth continues on the same trajectory, then you have that cost growth which would be similar to what happened last year, right? So EBITDA growth in that fashion currently what is there is, it should be that plus, because you get some operating leverage as well. So whatever EBITDA growth that you have over here, you're going to continue having that, right? Then comes the new hospital. The new hospital will be, let's say, the first 300 beds. That's about 7 to 8% further capacity. That 300 new beds, day one will obviously start with the lower ARPOB and negative EBITDA to start with. Then the question is, when do you break even? Do you break even in 6 months? Do you break even in 8 months? Do you break even in 12 months? If you break even in 12 months, then it will have a negative listing on the EBITDA. If you break even in 6 months, then 1 year later, it may be a neutral impact to your EBITDA. So but a neutral means it still will pull it down, because if it's zero, you're taking a positive EBITDA and you're taking a negligible EBITDA and kind of this thing. So you've got two conflating kind of winds happening over here. But my belief is, because it's only 8% on the overall this thing, it doesn't move the needle too much.
Understood, sir. Understood. Thanks a lot for this.
Thank you. The next question is from the line of Karan Gupta from Varanium Capital. Please go ahead.
Yeah, hi. Good morning. Am I audible?
Yeah, we can hear you.
Background disturbance and your voice is muffled. I would request you to use your handset, please.
Yeah. So basically my question is related to the international business. So what kind of traction we are seeing in the television for the medical tourism, and what's the steps we are taking to increase that traction, or maybe increase or improve the quality of our treatments? Because asking this question because in India the treatment cost is, I think, 1/5 of what the US and Europe is. So what's the traction coming from US and Europe? Because basically you said in your early Concall that the major traction is coming from the Bangladesh. So what's the position of this two big regions, US and Europe?
Well, we don't get many patients from US and UK, because US and UK in India is much cheaper, but it's sponsored, right? It's sponsored. NHS pays for it. And in the US also government, it doesn't matter if it's expensive, somebody else is paying for it. So it's never been my case people from developed countries will come to India. It will only be people from countries where it's self-pay which will come to India.
Okay. So when you talk about medical tourism, so what's the the patients? Where are the patients coming from?
We're getting the patients from 145 countries.
Okay. And yeah, that's it. That's the question. That's it. No.
Thank you.
The next question is from the line of Amit Kadam from Canara Robeco Mutual Fund. Please go ahead.
Hi, Amit.
Yeah, hi, sir. Good morning. So just a couple of things on this, the swing what we saw in the inpatient volumes this quarter, largely you attributed to the vector-borne disease. Just wanted to know, because we have a very limited understanding, like in last 3 years or so, we haven't seen such kind of large swing, because the bed days for this quarter is negative 1%. So can you just throw back from your past experience that have we had seen such kind of large swing which could have a material impact on the inpatient volumes and which could result in the bed days?
No, so what we are saying is last year, same quarter, okay, we had a big influx of dengue patients.
Okay.
We haven't had the same influx this year. So therefore, what you have is the reduction of 1% on this thing. But Yogesh,
so Amit, I think if you see the historical trends, you'll find that quarter 2 to quarter 3 there is always a decline. If you pick up any competitor, any previous reports of quarter 2 to quarter 3 comparison previous years, you'll find quarter 3 is always softer, right? Now, and so minus 1% OBD is very normal. If you compare Apollo, Fortis, Narayana, you pick up their last year results. Obviously, this quarter is not out, but you'll find that there's a decline in quarter 3 over quarter 2. So there's no exception here, right? So I'm saying this is the secular trend. You'll always find quarter 3 is down compared to quarter 2 because of the festivities, etc.
Diwali, Dussehra, Christmas.
Now, in our case, one peculiar feature is that in last year, since especially in Delhi, we had influx of patients in October, right? Typically, dengue finishes by September. But last year, we had, even in October, which was a Diwali month, we had dengue patients, and the Diwali month occupancy was 76%, right? Which is generally unheard of, right? In a Diwali month, you will have occupancy of less than 70%. So last year, October was very high occupancy because of dengue, and that's the reason why you see a drop a bit more sharper. Right. Otherwise, it would have been probably flat. If I really take out the drop in the internal medicine and pediatrics where we get this patient admitted, that drop is 12%. Right. While you see, Y and Y, the drop in OBD is only by 1%, but that particular specialty, which is 22% of the overall bed share, dropped by 12%. Right. Which is because of the fact that in last year October we had dengue patients. So I think what we're trying to say is that there's nothing operationally wrong in this quarter. It's only when you compare Y-o-Y, because of this October influx of patients, there is a bit sharper drop rather than what it should actually look like. So if I really adjust it, then you'll find that the OBD actually went up Y and Y.
Historically, see, it's a seasonal business, right? Second quarter and fourth quarter are the strongest quarters in the hospital business. The first quarter and the third quarter are weak quarters. First quarter because your cost structure sort of moved up, but your third quarter because your revenues come down.
So is that clear, Amit? Is there any?
Yeah, I was just not contesting you that particular point. I just wanted to know, because we have a very limited history, because we got from the data point we did not have. I did not have the insight that whether such kind of some seasonalities. When I'm talking seasonality, I'm trying to compare Y-o-Y, because of some like vector-borne disease can have a material impact on the volume growth Y-o-Y. I can understand how quarter 2 to quarter 3 seasonality works, but I was just saying in the past history whether such kind of events like vector-borne not there could have a material impact on the volume growth. Just wanted to
100% it does.
Okay.
I mean, it did in this year, right? Because last year, quarter 3, as I said.
And it's not an anomaly.
Yeah, it can. I mean, because it depends on when rain happened, when this epidemic type stuff happened for.
But why? But you're not comparing 9 months to 9 months. You're only comparing this quarter to last quarter. On an overall annual listing, etc., it'll be not a significant impact, right, on your occupancy.
Right, that I get it, but first time I saw this.
But yes, I mean, you can, if you don't have a dengue season, you can, I mean, in fact, a drop can be much sharper than this, much sharper than the 1%.
Okay. And just on the...
1 to 3% fluctuation on both sides, positive as well as negative.
Okay. Got it, sir. And just on the outpatient thing, is it just an outcome of the similar effect that because there were lesser patients visiting because of there was no disease?
That's right.
Okay. So nothing much to read in this particular thing based on this particular like why it was this, like because I've earlier seen this outpatient at least growing at mid-teens or kind of thing, but now which showed 3% in this particular quarter is nothing much to read.
So I think one thing you're rightly doing is you're looking at it year on year rather than quarter on quarter, because, like I said, you have seasonality in this. So your third quarter in any case is weaker than your second quarter. But if you look at it on a Y-to-Y basis, you can attribute it to the number of dengue patients in Delhi.
Okay. And just one more final point is on the Lucknow thing. So, as per the current timelines, we should be able to integrate that particular business financials to ours by quarter one next year, FY25. That could
yes. Yeah. I mean, depends on when does this closing happen. If the closing happens in this month, then we'll have to consolidate from the date of closing, right?
Yeah.
So we don't have a choice.
Fair enough, sir. Thank you, sir. That's it.
Thank you.
Thank you. Ladies and gentlemen, this will be the last question for today, which is from the line of Alankar Garude from Kotak Institutional Equities. Please go ahead.
Hi, good morning. Good morning, everyone. So, on that question on ARPOB, we have reported a 15% ARPOB CAGR over the last 3 years, and you alluded various factors, case mix, international, institutional, insurance, etc. Now, would it be fair to say that a larger chunk of this improvement can be attributed to an improved case mix?
So, Alankar, if you see the elements of ARPOB increase. One is the increase in the prices, right? Which I think we've been saying that it can be up to 3%. Then there's an increase in OPDs. You know that OPD revenue increase will improve the ARPOB because you don't consume any beds for those OP revenues. So that typically contributes around 2%. So this makes 3 plus 2, 5, right? Then you have, oncology growing. In our case, you've seen the oncology growth is, outpacing the overall growth. So that oncology happens to be a high-end specialty. So that typically adds 2-3% to the ARPOB. And then comes this whole, channel mix and the case mix. I'm saying if you take out the oncology out of the case mix, then there is balanced specialties and the channel mix. I think that typically has been contributing around 6-7% increase. And I don't see any reason why it should not going forward. So from my perspective, I think if there's a 9-10% growth in ARPOB, that should be reasonable.
But, having said that, you have to keep in mind one thing. We are talking about a healthcare system where there is capacity constraint in some manner, right? I mean, you've got occupancy levels which are pretty much at the threshold. When you have that situation, then typically you'll see a higher uptake on ARPOB compared to vis-a-vis occupancy, because you can't move up on occupancy. There isn't so many beds. So more and more patients get sort of pushed to daycare, which lead on, smaller surgeries compared to larger surgeries. So you kind of schedule the larger surgeries first. The smaller surgeries are scheduled or the appointments are given at later dates, etc. And some of that later date kind of evaporates. So what you see is the quality of work starts moving up. But at the same time, if I had a magic wand and I could put up beds adjacent to each one of the hospitals, then what you would see is a higher uptake on occupancy and lower this thing on ARPOB. There's always an interplay between the two.
That's helpful. Maybe a question linked to that is, as we double our bed count over the next 4-5 years, would the case mix for the newer beds be as good as our flagship hospitals right from year one, or the ramp up in the case mix would be more gradual?
No. So if you take Shalimar Bagh, right? And, Shalimar Bagh, we did a brownfield. So you can look at expansion akin to, and 85% of it or 90% of it is brownfield essentially, right? So if you look at Shalimar Bagh, where we added the 40% or more beds, then you see our experience over there. Now, the beds which got taken up obviously get taken up more by the institutional business that we are kind of driving out. So therefore, if you see our institutional business, we say apple to apple, year on year, it is the same. But if we look at ex-Shalimar Bagh, then we are far better in the institutional, because the institutional overall has come down there. But what it means is, even if your ARPOB, your operating leverage is so significant, okay, that your EBITDA per bed, which comes out of from the incremental beds, is significantly better.
Yeah, so I mean, suddenly the ARPOB growth in Shalimar will not be the overall growth; it will be less than that.
Fair enough. My second
bed and in fact the operating margin even from these beds, okay, is higher than the existing beds.
Yes.
Understood.
Yeah.
My second question is, you spoke about the potential of Lucknow and Uttar Pradesh for us in general earlier. Now, when it comes to expansion beyond our already announced plans, you had said earlier that we are looking at some 20-21 cities for potential expansion. Will we continue to aggressively look out for acquisition opportunities in these 20-odd cities now, or do our priorities get aligned more towards Uttar Pradesh now with the Lucknow entry?
No, so priorities don't get aligned from that standpoint, because it's not as if I'm going to get 2 or 3 acquisitions in a place like Lucknow. Even if you have a strategy, you're looking at building it out, etc., it's going to still take some time, right? It takes years. We're looking at deploying our balance sheet today. So, and we have the wherewithal to do it. For us to add 1, 2, 3, 4 hospitals in a space of 1 to 2 years, etc., is not a big thing, because the rest of the things that we're doing is essentially brownfields in any case. I mean, it doesn't tax me more. I mean, it takes me as much effort to do expansion on Shalimar Bagh as operating Shalimar Bagh. And similarly, wherever we're doing brownfields. So from both from a financial or a human resource standpoint, we are quite comfortable with what we are doing, and we are prepared to go to these cities as well. And we are actively looking at, I wouldn't say aggressively, we don't like to do things aggressively, but we are actively pursuing opportunities in other cities as well.
Understood. Thank you and all the best.
Thank you.
Thank you.
Thank you. As that was the last question for today, I would now like to hand the conference over to the management for closing comments. Over to you.
So thank you all for being on the call yet again for the third quarter, and we are looking forward to a robust and a strong Q4, as usually is the case because of seasonality. Thank you so much.